Well, welcome everyone. It's quite a cold day here in Helena. I hope those of you who are calling in from other parts, you're probably just as cold, but hopefully not too much colder. We have a couple people calling in from Washington, so hopefully they're doing better. Just a couple of housekeeping things. Again, press *6 to mute your line. We love kids and cats and dogs and typing computers, but we probably don't want to all hear them. Also to let you know, we have 72 people registered for this webinar, so having quite a large number of people muting your line is going to be really important. If you have any questions for me during the course of this webinar, you can use the chat function to send questions, or you can wait for the Q&A session at the end of the webinar, which I'll leave some time to do that. Also to let you all know, this call is being recorded, and we're doing that so that those who can't attend today will be able to come back to our website and listen to it. So let's get started. This is Endowment Building and the Montana Endowment Tax Credit. I'm Amy Sullivan, the Director of the Montana Office of Gift Planning, a newly created office within the Montana Community Foundation. I'm pleased to be here, and I'm so thrilled that so many of you are on the call today. Thanks for joining us. First, whenever I talk about giving, I want to share that America is a nation of givers. Almost 96% of Americans give to charity, and no developed country approaches American giving. The closest is France, and we give at a rate of 3.5 times more than France, and that giving occurs at all income levels. Why do I share this? I share this because those of us who are in the field of fundraising, we need every now and then to know that we're not talking to people who don't expect to give. People are givers. It's just a matter of convincing them that maybe our charity or our cause is where they should be giving their money. To look at the 2013 contributions by source, you can see that 72% of all funding for charity comes from individuals. And if you add in bequests, which that usually comes from individuals as well, you're talking 80% of the giving in the United States comes from individuals. Why do people give? I've highlighted two here. Give back to the community. Since we're a community foundation, that's highly important to us and all of the causes that fall under a sense of community. But also being asked. 48% of people give because they are asked. And so if you combine that with the fact that almost all adults give in some capacity and that half of them give when asked, we're going to be pretty successful at it if you just ask. So now to get to the true topic of this webinar, what is an endowment and why do we care? Well, the official definition of an endowment, you'll see up on your screen, a financial asset donation made to a nonprofit. Most endowments are designed to keep the principal amount intact while using the investment income from dividends for charitable efforts. Endowments are really a way to keep the wolf at the door, so to speak, at bay. If you are in a nonprofit where you find it incredibly hard to make operations annual giving goals, it's hard to think about endowment, something that will pay you later. But if you don't think about it, you will always have those worries at night and those concerns because you won't have this great equalizer of endowments that really is the key to sustainability for so many organizations. And then why is right now the best time for us to raise these kinds of funds for our future? That has everything to do with the Montana Transfer of Wealth study that the Montana Community Foundation did. I believe the original was 2005 or 2006. They redid it in 2011. And this chart is a significant chart because we know transfer of wealth is occurring. It's occurring everywhere. And in the United States, the red graph, it's an upward swing, which is what you would expect. And in Montana, it really levels off here in about 5 years. And that's okay. It's the rural graph that really needs to be paid attention to and really is the focus of our efforts in keeping some of this wealth in Montana and helping folks to realize this place where they have done well and that they have this assets usually is because of their hometown. So how can we get people to think of Montana as a child or stepchild in their estate planning? And we'll talk a little bit about that. The next few slides I have loaded with information. I know that's a no-no in PowerPoint, but I really want to get these these statements to you and for your use when you're talking with folks, or if you're a donor, for you to understand what's going on with the transfer of wealth. The study indicates that over the next 50 years, $123 billion will transfer from one generation to the next in Montana. If 5% of that were captured, can you imagine what kind of nonprofit schools and communities the state would have at $6.1 billion? It would generate $307 million per year to our charitable institutions using just the standard payout. But imagine that, 5%. I think each and every one of us really could write a will that said 95% of everything I have goes to my children, my heirs. But how about 5% for this great state? I really do think we could accomplish that, and look at what the numbers do. We have a long history of exporting our wealth, like so many Western states. Many of our children don't live here. And we're experiencing the peak years of wealth transfer over the next 10 years due to this out-migration. Now, that doesn't mean that our children don't give back. We certainly here at the Community Foundation get quite a few phone calls from people who don't live here, who have connections or had connections here, who do give back. But we want to talk about this before it leaves to see if there isn't some way to get this money into endowments now. We also have a rapidly aging population. By 2030, 15 to 25% of our population will be 65 or older, placing us among the top 5 states. And that aging population is, of course, driving the transfer of wealth and the urgency to begin that wealth transfer. Also a note, there has never been a wealth transfer this large in all of human history. And so it's a unique circumstance, and it's something that we definitely should be taking advantage of as people who run organizations, as donors, etc. The transfer of wealth analysis provides a picture of opportunities too. And we talk about, think about what makes Montana special to you and commit to give to that passion. Call us or the organizations represented on this phone call and to learn more about leaving a legacy. Create an estate plan or adapt it to help a cause that's important to you. Talk to others, remembering community, and give at least 5%. These are kind of the things that we share with folks. Any questions so far? All right. So how best do we capture endowment funds? Well, through planned giving in the Montana Endowment Tax Credit. What is planned giving? There is your official definition, but really it is gifts to be received later, and it fits beautifully in with endowments. It's donor-centered fundraising. Most of the planned giving vehicles really are gifts that give twice. The person gives to the charity, but they also receive something in return, and more than just the warm glow of giving. And we'll go into that in just a moment. First, I want to talk about the Montana Endowment Tax Credit. Always remember it's a credit. It's not a deduction. It's a credit on your Montana taxes for a planned gift made to a qualified endowment. The Montana Endowment Tax Credit expires 12/31/2019, and that's a few years off, but we also like to remind people this may not be something that we have for forever. So the transfer of wealth combined with the Montana Endowment Tax Credit really is a wonderful combination for growing endowments right now. So what is the Montana Endowment Tax Credit? It has two components. There's a credit for individuals and there's a credit for business. Individuals, planned gifts only. What does that mean? That's your annuities. That's your trusts. Those are those planned giving vehicles, and I'll talk a little bit about them. The gift has to go into an endowment where the principal is preserved and the earnings can be expended. The credit is equal to 40% of the charitable value of the gift. Now that's not 40% of the value of the gift, it's the charitable value. So for instance, if you give $10,000 in a planned gift to an endowment, Your Montana tax credit would not be $4,000. It will be close, though. It depends on what the charitable value is. You can take advantage of this. The maximum you can take is $10,000 per individual, $20,000 for couples. That amount is usually achieved with a contribution of $25,000 for an individual, $50,000 for a couple if you want to max that credit out every year. Corporations, they get 20% credit. They do not have to make a planned gift, so they can just write a check, but they do have to give that check, a donation, to a qualified endowment. Applies to corporations, small business, partnerships, limited liability. We have a lot of donors who take advantage of both. So they do it personally and they do it for their business. It's just a wonderful tool to have, and we're one of the few states that still has this after the recession. Also, too, when we talk about giving, a lot of times we're just thinking about cash, but there are other ways to give. You can give cash, of course, fully deductible for itemizers. A good point to always make. If we're talking with donors, or if you're a donor yourself and you don't itemize your taxes, you can't take advantage of any of this. So that's the number one qualification. You have to be an itemizer. If you give cash, you give up to 50% of your adjusted gross income you can deduct, and you may carry it over for 5 years. You can give appreciated assets, long-term owned property. Full fair market value of asset is deductible, up to 30% of adjusted gross income, and the excess can be carried over 5 years. And you pay no capital gains tax on appreciation. But you will see a difference between cash and appreciated asset. You will see that cash you can deduct up to 50% of your adjusted gross income, appreciated assets 30%. Why is that? Well, the IRS, it gives with one hand and it takes away with the other. And so the IRS says you're avoiding the capital gains tax, so we're only going to let you take up to 30% of your adjusted gross income. It is still a very good deal for donors. You can also give other non-cash gifts, and that's usually your art, rug collection, bronzes, you name it. And that is fully deductible up to the appraised value. And items valued at over $5,000 must have an independent appraisal. I do have a word of caution under the other non-cash gifts, and that is if you have a nonprofit and you're taking those in, this Form 8283, you need to be aware of it. If you sell, let's just say a painting, the appraisal comes in at $15,000, and the donation comes in at December 30th, and so you say to the donor, thank you so much for the donation of the painting valued at $15,000, that's your tax deduction. If you sell that painting within 3 years and it sells for less than $15,000, the donor actually needs to go in and do some recapture on their taxes and report that it actually sold for less. So be very careful with art. And there's non-cash gifts as well. There's two things you can do. One is make sure the donor knows you will be selling it right away. And a lot of nonprofits right on their gift acceptance policy say, we're going to sell it right away. Make sure they know that their deduction is going to be equal to what it sells for. Or you can offer to people to hold that item for 3 years. And if you hold the item for 3 years, then there's no question they're able to take the appraised value. They don't have to change their taxes later, but it means you have to store it for 3 years. So I just like to highlight that a little bit because I am hearing from some of the nonprofits that are selling it and not letting the donors know the difference, and we want to be good to our donors. How to give. Now, we couldn't talk about endowment giving and the Montana Endowment Tax Credit if we don't talk about planned gifts. And since I'm the director of the Office of Planned Giving, of course, I can't get away with not talking about it at least a little bit. So I would like to go just cursorily into some of these gifts. 80% of charitable giving in Montana is through wills. So people put you in their will, and it's really easy to say, would you please remember my organization or my cause in your will? I put some sample language in here. I put the community foundation on here because it would be impossible for me to put all the different groups. But you would say this language is a direct donation to you, so that's the easiest language. I have other language, so if you're interested, you can give me a quick email and I'll shoot those off to you. My email will be at the end of this presentation. But it's really easy to ask people to include you in their will. It's also really good that if someone says that they put you in their will, ask for a copy of that section of their will so that you can thank them and so that you can plan ahead as to how much you could be receiving in the future for future planning. And that way you don't ask for the whole will because you're not really interested in the other parts. But it's good to see the portion of the will that pertains to you. Then to always know that if a donor comes to you and says, you know, I want to put you in my will, I'm not sure if I should put you in for a dollar amount, a percentage amount, or the remainder of my will. And all that we're seeing and the advice that we're giving is if you're ever given that choice, make sure that you ask for the remainder. People constantly undervalue their estates. And so people who get remainders do far better than people who are put in for a dollar amount or a percentage. Now, a lot of donors won't ask you that. You won't have that opportunity. But if you are asked, go ahead and do that. Now, I have a question that just came in from Angie. She wants to know if these slides will be made available to the participants, and the answer is yes. These, one, you'll be able to go in and view this on our web page, but if you want to copy this presentation, send me a quick email, and I'd be happy to email you this PowerPoint. Charitable gift annuities. That's a contract between you, the donor, and a nonprofit that involves the transfer of a gift. And remember, that gift can be cash, property, art, to the charity in exchange for income now or income later. Income now is called a charitable gift annuity. Income later, a deferred gift annuity. And I'm sorry if I'm just throwing this all at you. There's a lot in planned giving. But I do want to say, a lot of people say complicated. I prefer to say creative. Planned giving is creative. So just keep at it. Keep listening to presentations like this. Go on Google, look things up. You will get the language and get it down. I'm doing my best to keep it as simple as possible, but of course I do this every day, so sometimes it isn't as simple to some of you as maybe I think it should be. Charitable gift annuities are appropriate for older individuals wishing a higher rate of return or any donor seeking to maximize the Montana Endowment Tax Credit. So remember I said that 80% of all planned giving in Montana is through wills. The other 15 to 18% is charitable gift annuities. So if all you really learn about is a will, which that's pretty easy, and charitable gift annuities, you will cover 95 to 98% of planned giving in Montana. And nationally, the numbers are very similar. So charitable gift annuities is where a lot of the action is happening with the Montana Endowment Tax Credit through the deferred option, and I will show you an example of that. Now, your current charitable deduction received is based on life expectancy, no capital gain on transfer of assets. A deferred gift annuity generally, always say generally, because here's where the creative part comes in, it depends on what numbers you're using. It depends on how far out you defer the payments. It depends on your age. It depends on when you give the gift. But generally, if you are in a higher income tax bracket, you will get a return of 70% of your gift the first year in tax deductions and credits. So I'm going to show you an example of a deferred gift annuity to show you the numbers. This donor is 60. In Montana, we are allowed to defer our deferred gift annuities all the way out to life expectancy. In this case, life expectancy for this individual, and it doesn't make a difference if it's male or female according to the actuaries, it's just the age, is 2035, is within life expectancy. It's not saying this donor is going to die in, 21 years. No, but it's saying life expectancy, you need to start paying it out. So to get the highest Montana Endowment Tax Credit and highest tax deduction, you want to do several things. One is defer it to full life expectancy. Second is to cap the annuity at 5%. By Montana law, we can go to 5%. We cannot go any lower. But capping it at 5%, deferring it to life expectancy, a $10,000 deferred gift annuity donation will immediately result in an income tax deduction of almost $8,800. In addition, the donor qualifies for $3,517.20 in a Montana Endowment Tax Credit. Then they will receive an annual payment of $500 starting in 2035. It's a small annuity because remember, we've put it all the way out to make the most and biggest tax advantage. And what it means is then the income is not really great. If you have a donor who wants income, you run a different number. You don't cap it at 5%. You don't defer it to life expectancy. But when we're talking about the Montana Endowment Tax Credit, this is the best tool we have to get the highest rate of return. Now, if you add $8,793 in the income tax deduction to the $3,500, you're well over the number of the donation. And earlier I had said you can get 70% of your money back. Where did I get that figure? Well, if you look at the income tax deduction, it's not a credit, you would take the $8,793 by your income tax bracket. So I said usually in the higher income tax brackets you get 70% back. So you would take the $8,793 times the highest tax bracket, which right now is 39.6%. And this donor would get $3,482 back on their taxes directly from that deduction. And if you add in the Montana Endowment Tax Credit, now that's irregardless of your income tax bracket. It's another reason it's fantastic. That total is $6,999.23. So that's where I'm getting the $7,000 back on a $10,000 donation. All right. All right, life insurance. Sorry, I had a little technical problem pushing the button here. People can also get life insurance. And it's appropriate if you have an existing policy and you don't think you need the cash value that's in it, or you wish to take out a policy and make the nonprofit a beneficiary. It's just another option. There's also an option for upfront, and so you make a large lump sum payment to the insurance, for the insurance, and that way you don't have to make payments every year and the charity gets it. You get the deduction for the cash surrender value, or if you paid an upfront life insurance policy, you could deduct those upfront payments. I put on here something called Saving the Family Farm and Ranch example. Our biggest goal here at the Montana Community Foundation is to increase philanthropy in Montana. We also help people every day with their estates, and not just increasing philanthropy. It's also important to us that in community, that some of these family farms and ranches that can be saved are saved. And so I want to share this with you. If someone has a farm, let's say, and I'm going to keep the numbers simple because I can't add it up in my head real quickly. Let's say the farm is worth $2 million. You have 2 children. You want to give the ranch to your eldest son named Charles. Your daughter, Susie, doesn't want the ranch or farm. So what's going to happen? If Charles doesn't have $1 million to give to Susie when mom and dad die, the farm is going to have to be sold. And not everybody wins. Charles doesn't get to keep the farm. Susie gets her money, but we've lost a family farm. I know this from personal experience. It happened to me. What can we do in this scenario to make sure this doesn't happen? Well, if the parents or Charles or Susie were to take out a $2 million life insurance policy on mom or dad, pay it up in advance. That's not cheap. I'm not saying this is cheap. That's probably $150,000 to $200,000. Some parents are doing this. We have one person, one sibling, who went out and took a home equity line of credit on his house to pay for this. And why would you do that? Because let me run you the numbers if this happened with a paid-up life insurance policy. Mom and Dad pass away. Charles gets the ranch, the complete ranch, $2 million. Susie gets the life insurance policy that's equal to $2 million. Everybody's happy. So for the cost of $150,000, $200,000, $250,000, you doubled your estate. You were able to give $2 million to your son, $2 million to your daughter. Under the other scenario, your son gets $1 million, daughter gets $1 million, you lose the farm. So when I talk to folks about this option, I then throw in, why don't you do a paid-up policy for $2.2 million, give $200,000 to charity. That's how we bring the charitable part into this. But I want to share this with you as those of you who are out there, or if you're on the call and you find that you're in this situation. Most of that wealth transfer that's occurring in rural Montana is because of this exact scenario. So let's do our best to let people know about it. It's their choice whether they do it or not, but at least it's a vehicle that we could look at to save the family farmer ranch. Charitable Remainder Trusts. Remember I said 95 to 98% of charitable giving in Montana is bequests and then annuities. The other 3% is really charitable remainder trusts. These are for very large estates, but they can be very helpful in terms of transferring and not paying exorbitant taxes. I'm going to also show you an example of this and one that we've been working on. Before I do that, though, I also want to say, you know, when people throw out these CRATs and CRUTs, you'll hear about those. Really, they're charitable remainder trusts. A CRAT, a charitable remainder annuity trust, is a fixed payment. A CRUT is a charitable remainder unitrust, the variable payment. That's the only difference. You run the numbers very similar, the contracts are the same, but their payments to the donor are either fixed or variable. That's really all you need to know about it. So here's another donor. They have a ranch. It's actually worth $2.9 million. They split off $900,000 of it, so where their house is, and sold it. That way they could take advantage of, every one of us gets the $550,000 home tax deduction. So the part that we're talking about here, the $2 million, is the rest of the ranch that they don't get a home deduction on. They have a basis in that $2 million in property of $58,000. They bought it in 1961. They have no heirs. They really don't want to sell it, but he's 83. He just can't manage it anymore. So they were talking to their accountant about selling it, and their accountant said, well, for anything above $1,942,000, you're probably going to have to pay almost half in taxes. So they're going to lose approximately half of their ranch. And they didn't want to do this, so they contacted us. And here's what we've come up with for them. They will transfer the property to the Montana Community Foundation. We will put it into a flip trust only because we want to sell it. When it sells, it becomes a unitrust, and the donors will get an income tax deduction of close to $1 million, and they will receive annual payments for the rest of their lives. Now he's 83, she's 68. She has the opportunity to get payments for 30 years. And their first payment will be $100,000. Now this is a unitrust, so it's not an annuity trust, so their payments will vary. And in about 18 years, their payments will be as high as $160,000 a year. When they pass away, the bulk of the trust and the interest off of it will, I should just say the interest off of it, will go to a charity in their area. So this is a wonderful story of, they could have sold it, they could have had $1 million in the bank, but instead they're going to get a tax deduction of almost $1 million, and they're going to receive payments for the rest of their lives that start at $100,000 a year and go up for them, and they get to benefit charity in the end. So again, it's about helping people and helping charities, but it's really a business of working with folks to solve a lot of issues that may be arising as this wealth transfer occurs. How about charitable lead trusts? These, we do very, very few of them. They're the opposite of a charitable remainder trust. So in the last example, the ranch was transferred to charity, and the income off of that goes to the donor. In a lead trust, the asset income comes to the charity, but the asset returns to the family upon death or a set number of years. Again, we haven't done very many of these in Montana. Not sure why, maybe because people don't think about them, but as things are really heating up and have been for a while in the Bakken, oil and gas leases are a really good option for this charitable lead trust. Spoken with a few folks where the money's been fun for a while, but they're on their 6th brand new pickup, and the money's lost its shine. And so we're having discussions about transferring the oil and gas lease income to charity. And upon their death, that oil and gas lease will flow to their family because they still want their families to have that asset. So these might become more popular as we move forward. I don't know. I'll let you know if they do. But I just thought I would mention there are charitable lead trusts, and that's how they can be used. Retirement savings. A lot of us have retirement accounts, or I hope a lot of you do, even if it's just a little bit. But sometimes we get to the end and we realize we were a lot more frugal than we thought we'd be, or maybe we saved more than we're actually going to need. And so what do you do with it? Well, I can say one thing. You should not leave your IRA to your children. Please don't leave your IRA to your children. I would prefer you give it to charity, but if you don't want to do that, I prefer you spend it. When your IRA flows to your children, it flows as ordinary income. So let me give you an example. You pass away and you give your IRA to your child, and they're in a low tax bracket. It doesn't take a lot to get you into the higher tax bracket. In fact, about $400,000. So if your IRA is $400,000, actually, if your kid earns $50,000 a year, it can be $350,000. You will throw your child into the highest income tax bracket, which is 39.6. And it isn't just the IRA that's taxed at 39.6, it's all of your child's income. So their hard-earned $50,000 a year also comes under 39.6. So the rate of tax is really higher when you add that all together because they weren't paying that on their original amount. In some instances where the estate is greater than $5.25 million, the tax I have been saying is 70%, it's actually 80%. Because, and this relates to very few of us, but there are some folks out there who have ranches who are worth greater than $5.25 million. What happens under that scenario is your IRA flows to your kid, it's taxed at the highest income tax bracket, and it is also subject to a 40% estate tax. So please don't pass your IRA onto your child. Under a best case scenario, it's going to be taxed ordinary income, probably at a higher tax bracket, most likely in the 40% range. But if you have a ranch or farm that's of greater wealth, or you just are of greater wealth, 80%. So like I said, go have some fun, give it to a charity, but don't give it to your kids. The IRA charitable rollover expired last year. We expect it to be reauthorized, but we also expect that to happen in January, which means a lot of us will be scrambling to get this done for 2014 credit during the month of January, February, like it did the last time. But I do believe this is going to come through again for us. So Another thing that we do is when we listen to folks and we hear them with open ears. And so many times I know when I speak with people and they think, or they say, I need all my income, I need all of it, my assets to live on. I don't take that as a no. I say, well, do you need the assets? Because a lot of times with these charitable vehicles, we can give a greater income than the assets may be producing. So in the case of that ranch that was transferred, the $2 million ranch, I know for sure that they never had income, straight income of $100,000 on that ranch. And you can see with that charitable trust that they're going to do that. So when someone says that, I just kind of say, well, do you need the assets? How about I can't give away my capital assets and tend to pass those on to my children? Well, that's an oil and gas lease scenario, that Charitable Lead Trust I was saying. I always ask people, well, that's great, your kids and grandkids, but do you need the income? How are your taxes with that income? Because we have a way to do that too. I want to help put my grandkids through college. There's also amazing annuities that you can compress the payments where instead of having it over their lifetime, it can come just during the 4 years their grandkids are in college. Those are called compressed gift annuities. So you can see these get very creative. I'm not using the word complicated, creative. But they're fun too. Your institution is not my only charity. Well, that's no problem at all. As community foundations, we do this all the time where people give gifts and they say, I want to help my church, I want to help wilderness, I want to help the animal shelter, I want to help whatever. And that's no problem. We handle those all the time, as I'm sure a lot of you do too. If folks say, I need all my income, most of my assets are non-income producing real estate, cash poor, again, that's the ranch scenario. A lot of times those assets can be transferred, and you will be doing a favor for these people. I put Bob Scriber Bronze Collection in here because I do hear this a lot. These are really popular in the 70s, and a lot of children are now like, I don't want Mom and Dad's bronze collection. So that's art that can be transferred to a charity. And the parents can get a good tax deduction because it's an appreciated asset. They probably bought a bronze for $1,000. It might be worth $5,000 now. So why sell it and pay capital gains on $4,000? Why put it in your estate, especially if your estate is risking being over the threshold, which is pretty high, but why put it in there? It's just best to donate it and let the charity sell it. And then, of course, this year's been very bad for me. My tax situation is awful. If you ever hear that, we can help people. They shouldn't have to pay such huge tax burdens when there's charitable options. So I wanted to leave lots of time for questions, and just a parting thought I wanted to say to achieve greatness, start where you are, use what you have, do what you can. And I would also like to say to donors, to achieve greatness, start where you are, give what you have, and do what you can. Giving at any level is important. It's part of who we are as Americans, as I said at the beginning of the presentation, and it's part of what's going to make our future a lot brighter. Any questions? You can unmute your line. Star 7 unmutes your line if you have a question for me.
Amy?
Yes.
Do you have sample contracts?
We do.
Okay. So if I emailed you, you would be able to email me some selections so I could take a look and see what they look like?
Yeah, let's talk about it. Go ahead and email me, say what you're interested in, and let's go through it because, of course, the contract amounts depend on some of those inputs, but I've got some sample ones I can send you. You're welcome. I also have a question here about, is there a simple 101 book you would recommend? I have not found a simple 101 book. I just had to learn this the hard way of doing a lot of other reading and all of that. I'll do some research, Joan, to see if I can find one, but I actually don't have one at the moment I would recommend. And then I also have a question of will I include speaker notes with the slides. I'm actually doing this, I'm speaking as I'm looking at them, so I don't have them written down. But if there's any points in particular you would like me to email you, I can do that too. This is open, and just please email me. And my email, as you can see, is amy@mtcf.org. I would also like to make the point that if you do not have a fund with the Montana Community Foundation and you want to talk to me, that is absolutely fine. Our number one priority is increasing philanthropy in Montana. So I don't care what organization you're with, and ultimately it doesn't matter if the funds come here or not. I'm here to help each and every one of you, so please contact me. Any questions? Any more?
Hi, Amy. Can you hear me?
I can.
I am a director of development for the Yellowstone Art Museum in Billings, and I use Crescendo software for our planned annuity gifts. Everything works out when I plug all the numbers in, but I was wondering if there's any way just to generically figure out what is the charitable amount of a gift without having to plug it in. A lot of times I get the call, I'm going to donate X amount. Is there any way that I can just inform them of what that charitable amount is without having to plug it all in?
The simple answer is no, but here is what I tell people who want to know right away. I mean, if the gift is $10,000 in that deferred gift annuity example and the write-off is $9,800 or $9,500, it's very close to the $10,000.
Right.
So you can share with folks 40% would be $4,000. You can say it will be under $4,000, but you're pretty darn close. Right,
and usually every time it's just right under that, and that's usually the best explanation, but I didn't know if there was some way just to compute that really quickly.
No, and I'm not an accountant or actuary to do that. So
okay.
but every one I've put in, it's so close. I just want to make sure people don't say whatever you give, you're going to get 40% back. That's not entirely accurate, but it's close. So you can say it's shy of 40% of your gift, and then you'll be doing them a service of not, making it deceptive as to the amount.
Right. And second question. I've had other people call in wanting to give two gifts, one to museum and one to another not-for-profit in the state. Is there a list of nonprofits in the state that I can provide for the endowment?
So let me make sure I'm understanding your question. You're at the art museum. You're having a donor who says, I want to give to the art museum, but I also want to give to the Heritage Center in Billings.
Yeah, MSUB, Planned Parenthood, etc.
Okay, and so you're wanting to know what charities could handle those donations?
Yeah, they've asked, is there a website or is there a list that they can go online and view that are charitable organizations that have the endowment that they can donate to?
You know what? There is not a list for that.
Okay.
But I would say in your area, you have a Yellowstone County Community Foundation.
Right.
We can also work with the donor to identify organizations in Billings to help to do that. We have a number of accounts in Billings.
Okay.
So community foundations are really good for that because we aren't beholden to any one charity. We don't hold one above another or anything else, and so we're a great clearinghouse for that. So I'd recommend when you get a donor doing that, or in your case, if the donor wants to make one gift, you may want the three of us get together and talk about a gift that then benefits you, and we can make separate payments to those other charities.
Okay.
And my services are free, so there is no charge for me to provide that assistance to you too. The only limit I have is I'm one person, so getting on my calling card early is good. All right, I have a question from Darren. He asked, for the typical small nonprofit that doesn't have PG expertise on staff, isn't it easiest to have donors consult their accountant or lawyer, etc.? Yes and no. A lot of accountants and lawyers do understand this stuff. A lot of them don't, and that I've found to be shocking. Either they don't because of disuse, they just aren't working in the charitable realm, or they just find it, in some cases, complicated, so they don't want to do it. So what I would say is ask them to talk to their accountant or lawyer, but if they're not getting any information on Montana Endowment Tax Credit, have them call us. And remember, Darren, you can say, we offer planned giving through the Montana Community Foundation. We can help you with that so that every small nonprofit actually can offer planned giving to their donors. Just work with us on it. I also have another question from Darren, and that is regarding the difference between individual and corporate donors to qualify for the Montana Endowment Tax Credit. Do you mean a corporation doesn't have to set up a gift annuity? Correct. A corporation can make a direct gift, and that's cash. Because I can't set up an annuity for a corporation. I can't make an annuity payment to a company. That's for individuals. So that's why the Montana Endowment Tax Credit just says that companies can give a direct gift, cash, to get their 20% credit. All right, I have one more question here from Kathy. What makes a qualified endowment? That's a legal term used, and I like to have it on there. It simply means an endowment that is managed as an endowment. So it is held in trust. The corpus is not spent. You have a payout policy that it is treated as an endowment. That it isn't something you create at the moment. It's either something existing or, in our case here, if the donation is great enough, $25,000, we can establish a new endowment. But it just means it needs to be treated as an endowment. And, of course, that has to be for Bill Pratt offers for a Montana nonprofit. But actually, we set it up for a Montana nonprofit. But in some cases, some donors want to give to organizations maybe outside of the state, and that is okay too. But our request here at the Montana Community Foundation is that half of the gift has to benefit, minimum of half, benefit Montana nonprofits. We rarely run into it, but sometimes we have some endowments, like for instance scholarship funds. They're endowed, but we give scholarships off it and the kid goes to college in another state. Then those go to, obviously, an organization outside the state of Montana. There are no stupid questions. The only way to learn is to just ask questions. So anybody have any more questions? All right. Well, thank you so much for joining us, all of you. It's really wonderful when we get to share this information with a lot of people at once. And like I said, please don't hesitate to contact me. I'll get back to you as soon as I possibly can. And if you're working with a donor and you think they might be a planned giving prospect, or if you're on this call and you're interested in making a donation, give me a call, and I'm happy to work with you. Thank you.